A dividend is a distribution of a company's earnings to shareholders. When a company makes money, it has the option to share that profit with its stockholders or retain that money as earnings, which it can then reinvest. If a company opts to pay dividends to its shareholders, they can be issued as cash payments or shares of stock. Since many investors appreciate the extra income that dividends offer, distributing dividends could make a company's stock seem more appealing. Investors often see dividend payments as a sign that a company is thriving financially and anticipates continued earnings, and therefore are more likely to buy its stock. The increase in investor interest can lead to an increase in demand, which can cause a company's stock price to rise. The board of directors can choose to issue dividends over various timeframes and payout rates. Dividends are normally paid monthly or quarterly. Investors often view the company's dividend by its dividend yield, which measures the dividend in terms of a percent of the current market price. The dividend rate can also be quoted in terms of the dollar amount each share receives. These are called dividends per share, or DPS. When a company decides to distribute cash dividends, those who hold stock receive payments based on the number of shares they own. Let's say you own 1,000 shares of a company's stock, and that the company decides to pay a cash dividend in the amount of $10 per share. Your payment would therefore be $10,000. A company might decide to distribute stock dividends because it's low on operating cash but wants to make its investors happy. Some companies may offer stock dividends because they offer investors more flexibility. A stock dividend isn't taxable until it is sold, whereas cash dividends are taxable immediately. For this reason, some investors prefer stock dividends to cash dividends. There are several reasons why a company might choose not to pay dividends to its shareholders at all. If a company is still growing, it may opt not to pay dividends so that it can reinvest that money to fuel its growth. Even established companies might choose to skip dividend payments and instead put that money to better use, such as acquiring new assets or funding new initiatives.